Hey everyone, welcome back to my channel. Sorry I've been away for some time. I had a little bit of leg injury I need to recover from. But now I'm back and I'm ready to talk about this week's topic. And it's something that all corporate owners often will ask themselves and also ask me during planning is when I pay myself, should I be paying myself salary or dividend? Now, when I plan with my clients, 9 out of 10 times they would tell me their friends or even their accountants are advising them to take dividend over salary because it is cheaper. And so you retain more money within the corp, you have more to invest, which is supposed to be better long run. I'm going to be showing you from a financial planning perspective why this may not be true and why you should really consider salary, at least give it more thoughts, because it can lead to a more optimal long-term plan. So in this video, I'll be showing you the difference between salary and dividend, why dividend doesn't really save you more tax, what is the trade-off when you take dividend over salary for a long-term planning perspective? And at the end, who should be taking salary or dividend and what are some exceptions? Hey, before we start, a quick reminder, help me like this video. All right, so first let's get the basics out of the way. Let's quickly talk about the differences between a salary and dividend. Now, the main thing about salary is it does require you to pay CPP. If you're paying yourself salary, you also have to remit this tax monthly. And also corporation gets to deduct the salary that you pay yourself as an expense. So it could lead to a lower corporate tax, but a higher personal tax. Finally, paying yourself salary helps generate RRSP room. Now for dividend, it's basically the complete opposite. You don't have to pay CPP on dividend. Dividend, however, cannot be written off as an expense, so you still have to pay the full corporate tax and then pay your personal dividend tax. This will lead to a higher corporate tax, but a lower personal tax. It does not generate RRSP room as well. Now, there are other caveats as well. For example, health spending account that will get affected depending if you want to spend dividend or pay yourself salary. However, for the scope of this video, those 4 are the major key points you should know and understand. That will be enough for us to move on. Now on there, obviously the most important thing is how much tax are we paying for each side. And this is why most people say it's better to pay dividend because supposedly you're paying a lower tax overall. So let's focus on this and let me tell you why this is not true. Now first, let's start off with the theory and look at what should happen if you pay yourself salary or dividend from a CRA perspective. So from their perspective, what they hope to achieve. And here they have done something called integration, which means they have kind of tinkered with the numbers, with the percentage, so then supposedly in theory, when you pay yourself salary or dividend, it makes no difference and you're paying CRA the same tax overall. All right, so let's go through a simple example together and let's assume there's Ross and she has a corporation that has a 100K inside and she's at 40% tax bracket and she's now either paying herself a 100K salary or paying herself dividend. Okay, so let's start with the salary side. The corporation first makes 100K, but because she's paying everything to herself, at the end the corporation makes nothing and so the corporation pays no tax. Now, on Ross's personal side, she now has 100K income. So her taxable income is 100K, and because her marginal tax rate is at 40%, she's going to pay 40% on it. So at the end, her total tax paid from corporation, which is 0, and the personal side, which is 40K, is 40K. So her after-tax income would be 60K. Now, on the other hand, this is what happens with the dividend. The corporation makes 100K, but there's no write-off because you can't write off dividends. So the corporation reports 100K of income, and assuming this is in BC, the total corporate tax for small business will be 11%. So she's going to pay 11,000. So the after-tax income within corporation will be 89K. Now on the personal side, she cannot pay herself 100K. She has to pay herself 89K because she paid some tax already. Her dividend income is 89K. Next, what happens is there's something called gross up. So when you pay yourself dividend, you have to bump yourself up. And for business income, it would be 15%. So 89K on paper is now 102,000. That's what she's reporting as taxable income. She pays 40% on it, which is going to be 40,900. But at the end, there's something called dividend tax credit, which for BC is around 11%. So 40K times this 10.99% is going to come out to 11,248. Her final personal tax will be 40K minus the 11K, which will give her 29,600 something. So her total personal and corporate tax, when you add them up, it's gonna be around 40,000. And in this case, she'll be left with very close to 60K, which is essentially the same as if she's paying herself salary. So this is what happens when CRA mentions integration, and when someone says salary or dividend, it doesn't matter, you pay the same amount of tax. However, right now, this is only true in theory. In that example I showed you, this is what salary is supposed to do. But over the course of history, we've changed tax rates many times, and what ended up happening is it's no longer fully integrated. When we pay ourselves salary or dividend, we actually end up with fairly, not large difference, but it's noticeable when it comes to tax differences. So assuming if you're in BC, I've built a chart showing you if you pay yourself anywhere from 50K to say something like 150K, this is what you end up paying in total if you pay yourself salary or dividend in terms of tax. So as we can see at all points on this chart, if we pay ourselves different levels of income, dividend is always more expensive than salary in terms of tax. But if that's true, then why do accountants or other people suggest dividend is cheaper than salary? Well, that's because dividend do not need to pay into CPP. Now, normally you would pay 4,400-ish if you're just employee, that's what you contribute per year. But in here, because you're both employer and employee, you have to pay both sides, and that amounts to 8,800, which is quite hefty. So if you add the cost of CPP to salary, then now it is true that salary will cost more than dividend. However, it's important we understand this distinction here, because it is not tax that we're saving on by paying ourselves dividend, it is CPP contribution. So we're giving up CPP by not paying into it. And this is something that I find most corporate owners do not understand when they start making these choices. So here I want to focus on the trade-off on what are we missing out on CPP by not putting into it. And there are two major components we should understand. The first one is CPP retirement benefits, and the second one is CPP disability. So we're gonna first start with CPP retirement pension, and in here there are three components that I find most corporate owners do not understand. The first one is the actual cost that you get to save by skipping CPP. Number two is what is the rate of return on a CPP pension and why it may not matter to you. And number three is the RRSP room that you also create alongside, and how does that affect you in the long run? So number one, let's talk about actual cost. Now on paper, we just said CPP contribution on both sides amounts to about 8,800 per year. So if I dividend myself today, am I really saving on $8,800 a year? And the answer is not really. Because first of all, by contributing into CPP, you do get some tax benefit back. The 4.95% base CPP contribution you make as an employee will give you a personal tax credit, which is worth around 20% of contribution. Now, the additional CPP contribution under the CPP enhancement is a tax deduction to your personal income. So depending on your marginal tax rate, this will give you a different amount of tax saving. On the other hand, the employer side of CPP contribution, the other 4,400-ish, is deductible to your corporation, which will help reduce your corporate tax. Now, on top of that, we have to remember that, as we just saw, dividend costs us more tax than salary. So we have to factor this cost in and understand that on one side we're saving 8,800, but on the other side we're actually paying more tax. And finally, another important thing about the cost is because dividend gets grossed up when we're calculating our income, it's gonna potentially lower our government benefit. One of the things that are usually gonna get affected directly will be our childcare benefit. I've built a chart showing the difference when someone have a 6 years old and they're looking to pay themselves 100K from the corporation, either salary or dividend. And here I'm just focusing purely on how much childcare benefit you lose in either situation. Now on the screen, I've shown a detailed calculation on both sides to show you what is the final childcare benefit you can expect. But if you're not interested in the details, just know that the person paying themselves 100K dividend instead of salary will lose themselves an extra $480 in childcare benefit. And that's just one child. If you have more than one child, then you're gonna lose more than that. So if you are a corporate owner with kids, then now it becomes more complicated and you have to factor in this loss of childcare benefit to the cost of CPP. So in conclusion, if we group everything together, at the end, you're not saving 8,800 by not paying into CPP. The more realistic number is somewhere around 6,000. And if you have multiple child, then that 6,000 figure also goes down. So it actually gets cheaper and cheaper to fund into your CPP. All right, so now let's jump to the second component about CPP, and this is the rate of return to replicate a CPP pension and why that rate may not matter to you that much. Because even after showing you all the math of why you're not really saving 8,800, you're only saving about 6K, you might still say, well, that's still 6K I get to retain within my corp. So I get to reinvest that in the long run and potentially I can replicate something like a CPP pension myself. Now that is true. And to do that, we need to know what is the internal rate of return to achieve this result. I'm not going to do the math in front of you because there's someone much smarter called Ben Felix who have done this math already. And he has said that on a normal retirement schedule, a CPP internal rate of return is really around 2.1%. But if you're delaying until 70 and have a longer life expectancy, then you can bump up this rate of return to around 3.1%. So you might look at this and say, well, that's abysmal, 2 to maybe 3% IRR. I can easily beat that. I can easily replicate this and do much better. Yes, that's true in theory, but now the onus is on you. And in order to replicate something like a CPP, you have to have three things. You have to have the discipline to save this amount or more every year. You have to make smarter investment choice or not get tempted by irrational decision, buy high, sell low, panic sell and all that stuff, which I see quite a bit. And number three, you have to withdraw the right amount every month in retirement and manage it correctly so you don't outlive your money. All of this will sound easy enough, but I can tell you after planning with hundreds of corporate owners, sometimes life gets super busy, business get chaotic, or there might be a down year. And it's really difficult to do all three things and stay consistent every single year. So in a way, CPP, while the rate of return, I agree, is not the best, it is a great hedging tool for us so that we can actually focus on our business or even do even more aggressive investment on the side, knowing that we have a government pension that will always be there and will pay us the amount it promised and is indexed to inflation. Now, finally, there is a bonus about CPP benefit that most people ignore, but I think it's very important for corporate owner, and it's that it is creditor protected. It cannot be garnished if the creditor is anyone but the government. So, if you are someone that's planning to run a business all the way until your retirement, there could be a chance where your business don't work out in the late stage. And having a CPP on the side, again, is another great way to hedge your retirement income. Okay, so let's move on to the third component. And this is the RRSP room, which is often overlooked and people don't really pay attention to how powerful this is. So when you pay yourself salary, 18% of your gross income every year up to a certain max, which is around 32K for 2025, gets turned into RRSP room. Now in here, there are three things that makes this RRSP room very valuable. The first one is the after-tax long-term return for your retirement versus just having all the money inside your corporation and investing. CIBC has actually done a really nice article comparing the effects of long-term investing if you retain everything within corporation versus if you have it out in RRSP every year or you max your TFSA every year, which one is going to yield you more money. The article, I will link it in the description, is quite long, it's very detailed. Now, if you don't want to read all that, just know that in conclusion, they've said that unless you have 100% deferred capital gain within your corporation, dividend or interest income is likely going to net you more in the long run after tax if you have it inside RRSP or TFSA. And we know that no matter how aggressive someone is, it's very difficult to stay 100% equity, 100% cap gain. You're bound to have some fixed income or interest or dividend in the long run. So maybe it's better to have those inside your RRSP or TFSA. But you can't have RRSP unless you pay yourself salary. Now, the second point that makes RRSP powerful is the creditor protection that comes with it. RRSP is creditor protected, whereas investment within your corporation, most of them are not. So if you're running a business again and you're looking out for your own retirement, maybe it is smart to have some of your investment in something that your creditor, your lenders, cannot put their hands on. Now, the last component about RRSP that a lot of people don't pay attention to is the passive income rule that can potentially affect you and your corporation. I've made video about this before, but essentially what this is salary knows everyone is trying to pay as little tax as possible and they don't like it. So they implemented this rule many years ago saying that you can only have 50K of passive income within your corporation per year. Any dollar amount over that 50K, you're gonna lose $5 of your small business deduction. Now, small business deduction is we have 500K to start with every year. That means the first 500K that we make within corporation, we're paying anything from 9 to 12% corporate tax only, which is extremely low, very efficient. But anything above that 500K, we're now paying around 27%, which is a lot more. So if you have 100K over, you essentially lost all 500K of small business deduction, and you have to pay your corporate tax at 27% right away for that year, which is very, very tax inefficient and very expensive. But as a business owner, I'm sure you know, if a business is anywhere remotely successful, it is very easy to accumulate enough retained earning to easily put you over the 50K limit every year. Just imagine like $1 million doing GIC at 2022 at 5%. You would have been over 50K easily. So this is something that every accountant pays attention for their clients. And RRSP is a great way to help mitigate some of this problem by moving it to your personal side, so you don't have to include this in your passive income, rule in your corporation. Now, lastly, there's actually one bonus reason why RRSP is powerful, and it's to do with a program called Individual Pension Plan (IPP). I'm not going to talk too much here; it's outside the scope of this video. But essentially, IPP is like a mini pension / RRSP plan that you can put within your corporation. It's extremely tax efficient. All that issue we mentioned about like creditor protection, passive income rule of the 50K, those do not exist within IPP. So you could still do investment within your corporation, but not be restricted by all those problems. But in order to have an IPP that makes sense and worthwhile to do, you need a good history of salary payment. So this is why salary, again, is one more reason why it is worth thinking about if IPP is a suitable situation, a solution for you in the long run. All right, so that's everything about CPP pension. Next, let's quickly talk about CPP disability. Now, many people know this program exists, but not many people know what it actually does and how much do you get paid. Basically, CPP disability will pay you if you have a long-term or indefinite duration of disability, you have a mental or physical issue that is stopping you from doing any substantial gainful work. Now, on this chart, I've shown you how much you can get on average. If you're someone with disability, you probably can expect $1,200 a month, up to a maximum of $1,600-ish. On top of that, if you have kids who is either under 18 or they're under 25 and going to school full-time, you will get a $300 per month of additional benefit per child. Now, all of this is indexed to inflation, but if we just ignore all that and just assume an example where someone is severely disabled for 25 years and they also had a kid when they first started to be disabled, this person can expect on average to get around 360K from the government or up to 500K, and the child benefit for this one child for the next 25 years would have been 90K, assuming they go to college full time. So as you can see, this is a lot of potential benefit that we might be giving up by not paying into CPP. Which is why during planning, if a corporate owner tells me they're paying themselves dividend, they're not paying themselves salary, they don't have CPP disability, one of the most important thing is have a very comprehensive and robust disability plan on the private side to replace the CPP disability, or else that person will be left with nothing if you get severely injured or sick. All right, so if you add up everything I just said about CPP, pension, the RRSP room, potential to do IPP, creditor protection, small business deduction, passive income problem, long-term growth for RRSP that's going to be better than retaining inside corporation, CPP disability potentially, they really amount to hundreds of thousands of dollars by having the CPP. There's actually one more abstract concept that we need to understand and keep in mind, because when we dividend ourselves and try to retain as much money inside corporation as possible, we essentially put all our eggs into the dividend or into the corporate investing basket, and that's all we have for retirement. One danger we have with this is in the long run, there could be substantial tax changes coming that could really affect how we retire. For example, the new capital gain change that went from 50% to 2/3 for corporation right away. We don't even get the tier system like we were supposed to get. That would have been in place if we didn't have a new PM. So that actually affects corporate owners drastically if that's the only strategy they have. So that's another thing to think about. Again, paying yourself salary, having CPP, having RRSP, and potentially even IPP and all that stuff is a form of hedging, and I think it's very worthwhile to consider if you're looking at long-term potentials. Now, with that being said, let's wrap up this video and talk about who should pay themselves salary or dividend and what is the exception here. Now, generally, I believe that for younger entrepreneurs, they should focus on salary over dividend up to age 40 or maybe 45. And the reason is because when you first start, cash flow is probably low, business is chaotic. It's hard to stay disciplined to invest into CPP, to put aside enough to pay tax every year, because remember, if you pay yourself dividend, you have to handle that tax bill every April and then every quarter after that. Whereas salary, you do have to remit that every month, so it's smoother and it's easier to handle overall. CPP disability should not be ignored, as we just saw there's hundreds of thousands of potential benefits that we could get from them. Building an RRSP room early and having salary history is great to set up your IPP, which should kick in around 45-ish anyway, so it's great to pay yourself salary all the way until then, establish a big IPP, and then consider to switch mostly into dividend. And finally, it's more likely you will be buying houses multiple times in this life stage. You are likely going to be building a family and you'll be upsizing. So which means you're probably going to be borrowing more mortgage. Salary is going to help you qualify for mortgage easier than dividend. However, finally, there are some exceptions to this situation. And I would say is if you're young and you're starting your business, but you have a spouse that have a really nice DB plan, maybe they're a federal employee or they work for a giant company like TELUS, and you expect them to have a very substantial retirement, guaranteed retirement income, then maybe there is some merit for you to forego CPP contribution, save a little bit more towards your company, use those funds to expand your business to go really aggressive because you have a very good safety net on the side already. I would say that would be a possible consideration, but still, I would still sit that client down. I would list out all the potential benefit we may or may not be giving up, and then make sure that client is fully educated before we make that decision with the accountant. All right, so that's everything for this video. Hopefully it can help you as a corporate owner have a better idea should you be taking a salary or dividend or a combination of both every year. Now, if you have any questions or if something more specific you want to ask me, let me know in the comment down below. And if you like these kind of videos, make sure you help me like this video, subscribe to the channel, click the bell button so you get all the notifications in the future. All right, this is Jacky. I hope you have a fantastic summer. I'll see you in the next video. Bye.